we analyze all the people who are dead after they, in their portfolio. They did better than the people who are calling me, making all these adjustments and all that. We were able to see that people who just set it and forget it and almost have time as an asset, and therefore the emotions don't get involved and they're not trying to outperform, but there's a system in place where they just let it run for months and years at a time without doing anything different. Those are the
That's
people
right.
who win. My name is Mike Fallat. I own the #1 book creation service for entrepreneurs known as Dream Starters Publishing, and I want to help you bring your story to life in a book so you can use that book to generate leads and attention for your business. Contact me today. Welcome to another episode of $1 Million Stories, where we get to interview authors from all over the world. I love talking to authors because they have the courage to take their thoughts, stories, lessons, tips, strategies, and put it down in a book and share it with the many, ultimately changing their legacy, destiny, and the world in the process. And if you're out there and you want to write a book, check out dreamstarterspublishing.com. We can help you out with wherever you're at in the process. And if you have a book that's already done, you want to generate leads for your business, check out bookmarketingcrm.com. Now, this podcast is for entrepreneurs looking to start or grow a business, but really it's about getting your money right. I think you need to get your money right in order for you to actually obtain freedom. So this book will help you understand income generation, because the book that we're discussing is called The Income Factory, an investor's guide to consistent lifetime returns. To give you a little backstory, I had one revenue stream up until 2020, and it scared the hell out of me when that one revenue stream was threatened. So it put me into hyperdrive mode, and I created multiple revenue streams starting in 2021. And now we're up to potentially, that's probably right around 15 revenue streams. The reason why is because income from many different sources, you could sleep better at night. And if there's a pandemic or the new world order does anything crazy, you're not as scared to wake up in the morning. So without further ado, we have the author of The Income Factory, Steve Bavaria, with us. Thanks so much for being here, man.
Hi, it's a pleasure. Thanks very much for having me.
Well, let's start off with the genesis of this book. What made you want to write The Income Factory? I love the title. I mean, it's simple. And
Here it is.
if you're making a machine that helps other people understand income generation and wealth creation, you're a friend of us, just so you know.
Well, thanks. I came up with the idea because I started out like most investors, where I realized from reading, that you can't really beat the average person cannot beat the average in terms of equity total returns over the course of their investing life.
The
Or
S&P
it would
500, it's very tough to beat it unless you're a politician, right?
That's right, and they call it the average. That's right, unless you have inside information, and
Right.
we won't go there. But I realized that if you can make the 9 or 10% per annum average over the course of your investing career, you'll be way ahead of most investors. That's the interesting thing. In fact, a guy named Charlie Ellis wrote a book about investing called Winning the Loser's Game, where he pointed out, and this guy's brilliant. He's actually still investing and writing, but most in tennis, he made the point in amateur tennis, most points are lost by people hitting bad shots. They're not won by hitting good shots like professional tennis.
Wow.
And it's true in investing as well, that more money is lost by people trying to beat the market than is gained by people who just invest like Rip Van Winkle and put their money in an equity fund, an index fund or whatever, and just let it go for 10, 20, 30, 40 years. And if they earn 9 or 10%, then their income is going to double and redouble again every 7 or 8 years, which means you're going to have 4 times, 8 times, 16 times what you started with, and you're adding more money to it all the time anyway. The statisticians can explain it. So that's how you really make money as an investor. And there have been Nobel prizes won by people at University of Chicago and elsewhere demonstrating this and proving it. But I learned, as many people do, that doing it is hard. Investing your money and then sitting there through the ups and downs of the market, just, and sitting tight and not trying to do something by hedging with low yielding assets, like you can buy long-term bonds. People will put 30% of their money in long-term bonds, which locks in, well, it was a 2% return until a few years ago. Now maybe it's a 4.5% return for 20 years or whatever. But a 4.5% return on a stable sort of asset's going to drag down your overall returns if you're shooting to make 9 or 10%, which is the equity return. So I found that this was really hard to do. The average person goes to the sidelines, they try to time the market. And typically, while some of them, and you read about the ones who make it, who really do well, but you never hear about the 10 or 20 others for everyone who does really well, who've only made 5-6% over the course of their life because they've had cash on the sidelines, when then the train pulls out of the station, the market train pulls out of the station, and you're standing on the sidelines watching it go because there's no conductor to blow a whistle and say all aboard, before the market takes off. So this kind of stuff. So I found, even though I knew the right way to invest was to just put your money in the S&P 500, where you'd get a 2% yield and you'd be counting on 7 or 8% capital gains year after year after year, not every year, but on average, which meant you'd have 20% one year, but minus 15 another year. And those other years are the ones where you tend to get panicky, like I did a bit, even though I've written this book and, I know in theory what to do. I got panicky at the beginning of COVID. I thought, hey, our government's in denial about this thing where, we had the Saudis and the Russians were killing the oil market. So that market was crushed. And I was worried, part of me at least, that we were on the verge of a 1930s type depression. So it's easy, even for those of us who know better, to kind of get panicky when things are down. So what I found was total return. If you're trying to make 9 or 10% over the course of many years, total return is a combination of the cash yield you get plus the capital gains on average that you get. If you do it with stocks, the S&P 500 yields just under 2%. So you're betting on that 7 or 8% in addition year after year on average. I thought, and I've got a background in credit, banking, all kinds of, stuff that involves lending to corporations and then trying to get your money back, which is what I used to do as a banker. But if you could earn a yield of 7, 8, 9, 10%, which is quite possible in the various high yield markets and senior loan markets, if you can earn 8, 9, 10% just lending to companies or big diversified groups of companies, you want to only do this on a diversified basis where you have actuarial, statistics working in your favor. If you can earn 8, 9, 10% and it never goes up, you have no capital gains, you've got the same total return over time. And what you also have is during those years where the market's tanking and you're only getting your 2% in yield, but you're watching your paper losses that might become real losses if you sell out and get panicky, you're not sleeping well at night. Mm-hmm. But if you're getting 8, 9, 10% in cash yield, even while your paper, on paper, your portfolio is down, you're actually reinvesting. You're watching that money come in every month like clockwork. You're reinvesting at bargain prices that are cheaper, than they were a month or 6 months ago. So you're actually, if you think about it as a factory, this is where I came up with the idea of an income factory. Ford Motors builds a new plant. The only people at Ford a week later who think about what that plant is actually worth if they wanted to sell it or whatever, because they're not in the business of selling plants anyway, are the accountants, the green eye shade guys in the back.
Yeah.
Everybody else at Ford is just worried about how much income is that, how many cars are they producing, and how do you grow that income? And I said to myself, this is where I came up with the name. If you think of your portfolio as a factory and its job is to produce cash income, and you're going to just focus on growing that income. So every month, if you're say you're 40, 50, 60 years old, you're not retired on it yet, because then a different strategy comes into play. All you have to do is reinvest that cash. It's like you're buying new machines for your factory. So you're expanding your factory all the time, getting new cash income from that factory that you're reinvesting to just constantly grow it. You're not even, if the price of that factory goes up and down and up and down over the years, over the months, you don't really care because you're growing that income, which is like growing your own pension plan.
Mhm.
Back 40 years ago, before they had defined contribution pension plans, before it became 401ks and IRAs that we had to reinvest ourselves, we became our own pension plan manager 40 years ago when we had to create our own growth, with our own 401ks and IRAs. Before that, people worked all their lives for a company for a pension, and they didn't even worry about what the value of the pension assets were that were going to pay them their pension for the rest of their life. Once you get into that mentality, hey, I'm building my own pension here, my own income factory. I'm not going to worry about how the factory's, valued, because actually, if you go back into the 1930s, there was a guy named John Burr Williams, an economist, brilliant guy, who came up with a theory that we still use if you in the MBA programs and corporate finance classes to teach the theory of investing, that the value of a stock or a bond or a piece of real estate or anything is the discounted present value of the total amount of cash it's going to produce over the next 50, 60, 80, 100 years, including whatever you sell it for at the end of that time, its terminal value. But that's that's what gives the economic value to an asset. It's cash flow that it produces over time. So I've just turned that theory into a practical sort of investment strategy. And then as I've been writing about it, I wrote the book. I started calling it The Income Factory on Seeking Alpha. I actually went and trademarked that name because I thought, hey, that's pretty clever. And then wrote this book that McGraw-Hill published. And now, and then started an investment service on Seeking Alpha that's now, out of 160 or so services, it's the 14th largest. And I never expected it to catch on so much, but I now have hundreds of people reading it and doing it and saying, wow, I'm sleeping well at night for the first time in years. You've changed my life. I'm so much more relaxed about my investing. So, there are no guarantees. Our country, our world, our economy, there's so much volatility and challenges. But I feel with this kind of an investment, often I'm doing high yield, you're buying debt more than you're buying equity. And I think of buying debt, if you think of the bet you're making when you invest, buying debt, issued by a company, senior loans, high yield bonds, you're betting on, it's like at a horse race, you're betting on the horse to just finish the race. The horse doesn't have to win the race. The corporation, its stock can go nowhere. It can have no growth at all. But as long as it pays off its debt, you're getting your 8, 9, 10%. The people who own the stock may be in the crapper, pardon me, but I'm sure your readers, your listeners have probably heard worse, and they will.
Oh, they've heard way
They will
worse.
if you keep but the point is, stock, when you invest in stocks, it's like betting on your horses to win or place or show, be up in the top. But if you're not getting paid more to take that risk, because everyone who buys stock is also taking the risk that all the debt above that stock on the balance sheet will get paid off. Because if the debt doesn't get paid off, the stock is worthless. So you're taking more risk when you buy equity than you do when you're buying debt. Now, I also do buy some equity. I buy utilities and things that pay higher yields, which are more debt-like, actually. But in general, I'd rather bet on horses, to just make it around the track, to, corporations to just stay alive and muddle through no matter what happens, than to bet on their equity, which then has to exceed rather than survive.
Wow, that's a great point what you just made there. So the fact of most people will do whatever is necessary to hit the minimum. And what you're saying is that to pay off debt is the minimum. So you have this phrase here, high yield doesn't have to mean high risk. Now, I was a finance major, and what you said, I don't think I've ever heard in school. So, and might have, I just maybe didn't pay attention, but I always equate high return with high risk, right? Wherever there's risk, there's reward. So That's not the case with what you're saying. And that's what you look for more than anything else, just a high yield. And that doesn't necessarily mean, due to looking at the historical data, that it's very high risk.
Well, absolutely. And I'm glad that was a great segue, and we didn't even practice this. So that was excellent, because a lot of people, and I don't blame them, they say, well, it's such high risk, that mean high yield must mean a high risk. And if you're in the equity world, where typical equities pay, a growth type company will pay 1.5%, 2%, a utility might pay 3 or 4%, maybe 5. And then the only companies that are going to be paying 7, 8, 9, 10% yields in the equity world are companies where that yield is at risk, where there's something going on in the company where you can't depend on that dividend to continue. And that's why the market's priced the company down to where its existing dividend is a higher yield, because it doesn't expect it to last. But when you move into the debt world, there you're actually being paid for credit. Now, I'm not talking about high yield investment grade bonds, 10, 15, 20-year bonds from the electric company or the telephone company. There you're really only betting on interest rates. You're not, with investment grade bonds, defaults are so minimal that you don't get paid very much for taking credit risk, because there's not a lot of credit risk. You're taking mostly in interest rate risk. So that's your bet. And that's a lousy bet, honestly. But in the credit world, when you get into non-investment grade, which is the majority of companies, people say non-investment grade, that's junk. Holy Christmas, that's too expensive. That's too risky for me. The point is, most companies are non-investment grade. People don't even realize. And I ask a lot of equity investors who say, oh, I would never buy high yield bonds or loans. That's just so risky. I say, well, do you own any mid-cap stocks or stock funds? Do you own any small cap stocks or stock funds? They say, oh, well, yeah, I've got a diversified portfolio. I say, well, all those, probably 99% of your mid-caps and all your small caps are non-investment grade companies. So you're buying their equity for whatever portion of your portfolio. I'm buying the debt of that same cohort of companies. That debt that I'm buying, that you say is so risky you'd never buy it, if that debt doesn't get paid, your equity is worthless. And then there's a little bit of a quiet, oh, gee, I hadn't thought of that, So there's so many misconceptions out in the market, and that's why I've been, I think, successful as an investor, but even also as a writer and proponent of this, because the light bulb goes off for people. It's, as you say, you've got a degree in finance, but you never encountered some of this stuff. Nor did I. I mean, I didn't study finance. I studied international economics and journalism and other things I did earlier in life. But yeah, you don't really, this stuff falls between the cracks, because people they're talking about bonds. Most bond analysis has to do with interest rate analysis and, duration and things like that. And most equity analysis has to do with, timing and, that sort of thing. But credit analysis is something bankers do. I was a banker for 20 years, and bankers used to just hold the loans on their own books. So nobody else had to know about credit analysis except the bankers who were holding the loans. Later, I went to Standard & Poor's as my second or third career. And because I knew about banking, Standard & Poor's always rated public bonds, but they never rated loans, because loans were made by banks and only held on the books of banks. So they weren't publicly sold and traded, which all began to change about 25 years ago. So I introduced, when I got there, I was just lucky I was in the right place at the right time, the idea of rating bank loans, which seems like a no-brainer, but it took me a while to convince them to do it, because there was a whole bunch of different things that they had to start analyzing. Like with loans, you've got security, collateral. So you can make loans to non-investment grade, low-rated companies that are good loans and well secured because you've got collateral. So when you rate them, you have to rate not only the risk of default, but then how much money you're going to get back if they do default and all this kind of stuff. It's kind of it's a funny story how it all happened. And I've got an appendix in my book where I talk about it as a sort of a case study in financial entrepreneurship, if you will, new product development, everything. So anyway, there's a lot to credit that is not nearly as risky as people think it is.
Yeah, I gotta look into that more because I have never heard it that way. So I interviewed a guy 2 months ago. He manages the portfolios of 250 of the wealthiest families in the country. And he had this amazing quote in his book, and it was, if you're going to invest, what I recommend is you invest like a dead man. And this kind of leads me to one of your other points here as a
Yeah.
summary of the book, but invest like a dead man. I was like, what does that mean? And he broke it down by saying, we analyzed all the people who are dead after they, in their portfolio. They did better than the people who are calling me, making all these adjustments and all that. We were able to see that people who just set it and forget it and almost have time as an asset, and therefore the emotions don't get involved and they're not trying to outperform, but there's a system in place where they just let it run for months and years at a time without doing anything different. Those are the
That's
people
right.
who win. And so when it comes to your income factory, it sounds like once you set up the factory, you just let it run. You have a certain process in place. You take the money, the dividends, whatever, put it right back in, and you don't think about changing the game. So when you talk about how to grow your wealth steadily without following the markets obsessively, in my opinion, it sounds like you set a process in place and you invest like a dead man. Am I correct?
Actually, a dead man who wakes up every few months and just spends an hour or so looking at their portfolio and then climbs back. Uh, it's interesting, the investing as a dead man. I've heard that before, and you might have mentioned that to me, actually, to give you credit. But that works perfectly. I mean, that works best for somebody who's investing in an index. If you're investing in index equity, that sort of thing,
Yes.
um, and just leaving it alone, Rip Van Winkle would have been a great investor, but all he'd have to do is put it in, an S&P 500 index fund or something. I actually designed my income factory for myself and mostly for people who don't have as an alternative. It's not better or worse than index investing. John Bogle at Vanguard, who really was the modern inventor of index investing, he had it right. What I designed the income factory for was, or evolved it for, in my own case, was more as an alternative for the people who don't have the iron will to sit tight through the hard times, if they're indexing. Because if you're earning the 8, 9, 10% in interest, in real cash you're collecting every month, then it doesn't bother you so much when the market tanks. If the market tanks and you're in an index fund, you're collecting your 1.5% yield, but if you're following it. Now, you're better off if you're not following it, but if you are, like most investors do, watch it and they see it going down and it's in the red, that's when they're more inclined to lose the nerve and not let their inner John Bogle guide them, but actually, do something stupid. And that's why I'm, with the income factory, I'm giving people a way to have something else they can watch, that they're still seeing that cash coming in, even if the market's tanking. And if they're active, as many of my members are, they're actively reinvesting the cash that's coming in bargains. They're looking around for what's down, what do I own that's down the most? And that's what I'm going to buy more of. So they actually, in a perverse way, we can get a little excited when the market's down because we're growing our income faster. And if you're in it for the long term and you then see your income continuing to grow, then you're not worried so much about the market being down. So this is an alternative, but Rip Van Winkle and dead men and women as investors don't even need an income factory. They can just invest in an index equity fund and probably do fine,
Well, that's why I like the title of your book, The Income Factory, because the great quote, cash is not king, cash flow is king. And it
Mm,
sounds like your major play is you want to increase cash flow. So therefore, they have the ability to invest if they want to and buy the dip, if you will, right? When you see the market
sure.
tank, I think you think like an entrepreneur and you say, wow, that's actually a good thing because I'll get it for a bargain. I will see something that I know is going to go back up, or whether it's has to do with utilities, whatever. I know it's coming back. Maybe the market's taking a little bit of a hit, but this is how I become wealthy. I buy the dip in certain aspects,
Right.
but you're also having cash flow. It's not just about net worth, it's
Well,
cash flow.
that's right. You're buying the dip. You're buying your new machines for your factory at bargain prices.
Bingo.
And frankly, if you once you realize that the market value, which is supposedly going to mirror the economic value of an asset, but not always today, not always next week. It may take a while for markets to catch up to the real economic value. But if you're focused on the income being produced, that's the real economic value, especially if you buy into what that economist John Burr Williams wrote that I mentioned earlier, that you know the more the greater the cash flow over time, the more the market, there's going to be pressure on the market to recognize that value. Markets don't always recognize things, value overnight or immediately. But if we're in it for the cash flow, and that cash flow is getting larger and larger and larger across, then the value, the underlying value in the market is going to eventually capture that, or at least move in the right direction. If you're doubling and redoubling and your income flow every 7 or 8 years, I mean, you're going to have a huge cash flow compared to what you started in just, 10, 15 years, 20 years.
Well, as an investor, you have probably lived by the law of 72 and certain,
Absolutely.
certain laws that maybe you take for granted now that you just know in and out. And maybe the average person out there who's listening to this podcast doesn't even understand the law of 72, but it's basically time becomes such an asset and your money doubles X amount of whether it's years or months. So anything that you live by, if there's any type of law or code or investor rule that you live by innately, is there anything you could share with us?
Well, yeah, you mentioned the rule of 72, which I do refer to a lot and think about a lot, because you you divide 72 by the percentage yield that you're collecting. So if you collect 7%, you're going to double your money, your income in 10 years, because 7 into 72. If you earn 10%, you're going to double and redouble your money every 7.2 years. So I mean that's critical. And then
Yeah, like every 9%, 8 years. And I think you have
that's
that a
right.
great example. So,
Exactly.
okay.
Every 8 years, 9 times, at 8%, it's 9 times. 9 times 8 is 72. So yeah, it's a good rule of thumb, and for keeping that in mind. And then you just try to find assets and asset classes that have a good where there's a good chance that you'll be able to collect that kind of a of a yield. Now, I don't expect over 20, 30 years that interest rate levels are always going to stay the same. So there are going to be times where earning, well, recently in the last couple of years, when high yielding assets were selling at bargain prices, because the market will bring these things down, like in the great crash of 2008 or
Yeah.
7, 8. You had healthy loans that were selling at 60 cents on the dollar, and healthy high yield bonds at 50, 60 cents on the dollar. So if you're buying funds that invest in these things, sometimes when the market, what Rothschild a couple 100 years ago said, buy when there's blood in the street, invest when there's blood in the streets, but that's sort of true about markets. So the last few years, some of the sort of closed-end funds, that hold high-yield bonds and senior loans that I buy, are business development companies, BDCs they're called, which are like middle market. They're like virtual banks, and they lend to middle market companies. They have close relations with private equity firms, so they often are lending to kind of in cooperation with a PE firm that they're close to. So you have an owner of the company who's your borrower, who's kind of in bed with you a little bit as far as they want to make, they're a PE firm that owns the company, so they have a vested interest in you as the lender getting paid and everything. So some of these kinds of investments that were able to pay 10, 11, 12%, because maybe they were earning 8% on their portfolios, but they were buying it, they were repurchasing assets, at healthy assets, at 70 cents on the dollar, and making capital gains in addition to that. So there's a lot of extra sort of juice in the high yield market if you sort of stay in it through the ups and downs, and invest with really solid portfolio managers, the kind of companies that are really good in this, or the Ares and Apollos and KKRs and Blackstones, and all of which have closed-end funds and even and ETFs. BlackRock is
Yep.
all of them.
Vanguard, right? I think Vanguard, State Street.
Vanguard is bigger in like index funds, big stock funds. I'm thinking more of like closed-end funds, which tend to be smaller.
Oh, okay.
But also are great funds for investing in less liquid assets, the kind of assets that, senior loans, high yield bonds, the kind of things that pay higher yields are more likely to be in smaller funds that may only be a few $100 million, which are not, and the assets themselves are not quite as liquid as you'd want to buy in an open-end fund. But in a closed-end fund, where the funds are bought and sold in the market, so you're able to buy at discounts to the net asset value at times, that they move around. And also, if people want their money back, you can't have a run on the fund. Instead, they're just out selling their stock in the fund, their fund investment. You sell it on the market. So funds like that are the kind you want to have if you're buying less liquid assets. And less liquid assets doesn't mean they're not just as solid, but senior loans, high yield bonds, things like that, managed by really professional investors, investment managers who've been doing it for years, are best bought in things like closed-end funds, where they can invest 100% of the fund in the earning assets, because they don't have to keep some in cash to redeem the shares like an open-end fund. That sort of thing. There are ways to do this that increase the possibility of you're getting a little more yield.
Well, you have your finger on the pulse of what's going on in the market way more than I do. But whenever I'm in these circles, I'm mostly working with individuals in the real estate space, whether it's life insurance space, certain entrepreneurial pathways that people take. I'm in those circles, not so much the trader world, but I will tell you that I'm starting to feel as if like people are holding on to their money, that things are getting tighter. It's getting a little bit more difficult, very much like 2020. There's a lot of fear that's happening right now. Maybe because it's an election year, maybe because it's what's happening with the economy, with the interest rates, and how it's a trickle-down effect. So I'm noticing that, and there's different strategies being implemented even within my company. So what are you noticing out there when it comes to the market? Is there anything that you're seeing that our audience would love to kind of maybe latch onto, or be prepared for?
Yeah, I'm the first to admit that I don't have any better, crystal ball than anybody else. I look out at our political situation, the economic situation, financial. We didn't have the big recession that everyone expected, or so many people expected a few years ago. And so then people started talking about, are we going to have a soft landing? I don't even know if we're having a landing. In other words, it doesn't seem like there's been any sort of final denouement to to what we've been going through. And it just sort of, the uncertainty just seems to keep getting pushed further and further out.
Right.
And that's why I think you see a market that's so, the market will get so optimistic. I haven't even checked what's going on today, but I mean, yesterday we heard, I guess, a somewhat more sanguine viewpoint from the Fed than some people were expecting. But I don't expect rates, if we need to have rates come down much in order for the market to really take off, I'd say don't get your hopes up too much, because I don't think we're all that high. By my, having lived over the last 40, 50 years as a working
Yeah,
adult,
you've seen high. Yeah, you've
I
seen
mean,
15,
my first,
16%.
exactly. So mortgage rates in the sevens are not that unusual. Rates for 30-year governments at whatever they're at, 30, 44% or whatever it is. I mean, I wouldn't invest my money for 30 years at 4%. So I think we had rates so artificially low for so long that people got used to it and now aren't quite prepared mentally for what are really going to be a more normal range of probably interest rates for some time to come. At least that's my expectation, which means, you know, it just reinforces my idea that credit is a sort of safe uh, sweet spot. And there was actually an article that came out just the other day from BlackRock. I can send it to you if you'd like, if you want to mention
Yeah,
it,
I'd like to check it out.
share it with people, on your platform. But it was making this point that high yield debt. I was thrilled to see it, and of course I shared it with my members. You always want to say, "Hey, I was right," once in a while.
Hey, Larry Fink agrees with me. Here, check it out. Yeah.
BlackRock agrees with me. So, but it really was naming this as a sort of sweet spot, saying you got all kinds of equity risks, but you also have interest rate risk if you go with traditional bonds. But boy, high yield debt, which tends to react on the upside like equity, but protects you more on the downside, seems like a nice, safe place to be, relatively. Nothing's totally safe in this environment. So I was happy to see that, and it reinforced my idea that, I don't want to be a hero, but if I can continue to make my 8, 9, 10% and just keep on compounding it, that's where I'm going to go, so it's not anything very flashy, but that's my
You're not
take on.
changing your strategy. I'd love to hear that because I know that there are
Oh,
many levers being pulled. It seems like you are still doubling down, living according to your code, consistent lifetime returns. Don't change it even when the market's adjusting. It's basically the same strategy. Maybe you just kind of see where the high yield is at, and that might adjust. That's it.
yeah, and let me admit, I cannot afford to go to cash. I mean, there are people out there who can afford to invest in, go to governments and short term and, collect 2, 3%. I need to make more than that on my money. Now I don't need to be a superstar, but I'm betting on corporate America, or corporations generally, to basically muddle through no matter what happens. I don't know what's going to happen, whoever wins the election. I don't know what's happening geopolitically, around the world, but I think corporate America is going to muddle through, because the other book I wrote, Too Greedy for Adam Smith, that I self-published 10 years ago, is about CEO pay and how it's so out of control that, it's not controlled by the normal economic forces that we usually, if you believe in capitalism, you believe in economic forces controlling prices and everything. But that's out of control, with CEOs setting their own pay, sitting on each other's boards, and not to get off on that, but CEOs have enormous skin in the game, and so do the people that work under them. So they are going to find a way to muddle through and keep their companies alive no matter what happens. That's my, absent, some world cataclysm or 1930s type depression that'll bring everyone down, then they'll muddle through, and I'm betting on their muddling through. That's my overall strategy,
Yeah,
really.
I think they'll be
Buy
propped
debt.
up. So I would say, in my opinion, that's a safe bet. I just think that, government will prop them up if they ever run into major issues. So I'm with you. I think that there's probably a real strong reason for them that they will muddle through, and corporate America needs to be around, and for many people to be taken care of. So it sounds like a safe bet. And so
Knock,
I
knock
do
on
want to
wood.
I do want to talk a little bit about this seeking alpha thing that I've been reading about on this summary. What is seeking alpha? And it sounds like they can go there to reach out to you. Is that right?
Absolutely. Seeking Alpha is a worldwide platform on the web, and you can find it easily by just searching Seeking Alpha. And you can, and I started writing on it 30, no, about 20 years ago, probably almost. And it has thousands and thousands of contributors who write about all manner of things that involve investing. And then a few years ago, and I was one of those contributors for years, uh, and I still am, and I have 16,000 followers or something. Followers are just people who say they like to read you. But then a few years ago, Seeking Alpha invited its contributors, if they wanted to set up subscription investing services that Seeking Alpha would host. So I'm now one of 165 or 70 people who have their own subscription services on Seeking Alpha, where Seeking Alpha readers can then opt to subscribe specifically. And it's all handled by Seeking Alpha. So they host it, they do all the administrative work, they keep a quarter of the subscription revenues, and I get the readers, I mean the writers, get the other three quarters. So it's a really nice opportunity for those of us who have a lot of followers. Like, of my 16,000 followers, only about 1,000 have subscribed, which is fine, because of 1,000 or 900 or so subscribers is still it's a lot more income than I expected it would be, frankly, 3 or 4 years ago when I started it. But I've really struck a nerve, I guess, with a lot of people with my income factory. And so anyone who goes on Seeking Alpha, or anybody who just searches my name, Steven Bavaria, on the web, they'll see I then have my own, there's a page on Seeking Alpha for my particular service. So if anyone clicks on Steven Bavaria and just follows it to Seeking Alpha, they'll get on a page that will invite them to subscribe to my service. They get a 2-week, no obligation free trial, where they can check it out, look at all the model portfolios, learn everything they want to know about it. And then if they don't want to subscribe after that, that's fine, no hard feelings. Although I was happy to say, I've got the highest conversion rate of any of the 2-week, everyone who goes on Seeking Alpha to any of these subscription services gets a 2-week free trial. I've got the highest conversion rate at about 60% of those who do the free trial convert to a subscription, when it's only about 15 or 20% for, I guess, most of them, if that. So somehow I've struck a nerve, and it amazes me. It's a wonderful group of people. We have a chat. They ask each other questions. They ask me questions. I'm thrilled to death that a lot of my subscribers answer each other's questions. It's like a little family.
Real community.
Yeah, so it's been really good, which I'm sure is what you've probably got among a lot of your loyal watchers.
Yeah, when it comes to our circle, it's basically a Facebook group, and it's amazing to see once you start to, put out a message, you have your personality actually creating your personal reality, as Dr. Joe Dispenza says, that the moment that people see who you really are, it's like, hey, that person aligns with me, and then they join the group, and it's weird how pretty much everybody in that group, they have a lot of core values that match up, and it sounds like that's what you've done. So.
Knock on wood. I've been thrilled to death. The feedback I get from people who seem to really have benefited. It's not that I've done anything special for them, except just open up a way of thinking about something that once they see it. In fact, you can read chapter 2 of my book and get the whole thing. I shouldn't say that, but they're just a couple chapters. The introduction and then chapter 2 will tell people all they want to know to really understand the philosophy. Then there's a lot of other chapters on the how to implement it and that sort of thing. So anyway, I appreciate the chance to talk about this, because as you can tell, it gets me excited. I'm excited about it.
Well, I just love anybody setting other people free financially. Rich Dad, Poor Dad did that for me, Robert Kiyosaki's book, and I was never the same. So if your book can unleash some people out into the world, and so they can create their own wealth and be in control of their financial destiny, I'm with you. So, guys, the book is called The Income Factory, An Investor's Guide to Consistent Lifetime Returns. There it is right there. It is in Kindle, audiobook, paperback, hardcover, and audio CD. That you don't see that too often, but 216 reviews on Amazon. It's resonating, 4.5 stars. So pick it up, and also take a look at his Seeking Alpha membership platform. It sounds like he's really doing well with the people, and it seems like they, even when they jump in, they don't leave. So it's working out. So Steven Bavaria, thank you so much for being here, man. I really appreciate your time today.
Well, thank you. And thanks to all your watchers for tuning in. Appreciate it.
2024 is going to be a year of chaos, guys. So get your money right, and this book might do that for you. Remember, $1 million book will lead to $1 million life. Right on.